Hi, and welcome to this video about what you need to know about running your limited company. In this video, we'll be covering such topics as what is a director, the director's responsibilities, what do you have to file, when and with whom, understanding your dividends and salary, and should the business be VAT registered, and if so, which scheme? What the company needs to file. In this section, I'll be discussing what the company needs to file, what you personally as a director need to file, and also the repercussions if these are not filed. So what does the company need to file? So let's break this down monthly, quarterly, and annually. So monthly, we have the monthly payroll runs, or sometimes known as RTI, or real-time information submissions. These need to be filed to HMRC monthly, even if you've not taken any salary. Quarterly, well, if you are VAT registered, this will be the VAT returns. For more information about VAT, please see our VAT videos. Annually, you would have the statutory accounts, which need to be submitted to Companies House 9 months after the year end. These are normally accompanied by the Corporation Tax Return, or CT600 for short. Now, the CT600 needs to be filed to HMRC 12 months after the year end. However, the CT600 needs to be paid 9 months and 1 day after the year end. So the CT600 payment and the statutory accounts being filed are normally done at the same time. If your accounting period is going to be longer than 12 months, so if you decide to extend it or lengthen it to say 15 months, please be aware that you still have to file a 12-month return, so a 12-month corporation tax return, CT600, and then another 3-month CT600. Another annual filing will be the P11D. This needs to be filed and submitted to HMRC by the 5th of July each year. Every year, the confirmation statement, or previously known as the annual return, will need to be filed to Companies House. If this is not filed, this may affect your company's credit rating. However, there may be some additional reasons why you need to file a personal tax return or self-assessment, such as other income through dividends, property or rental income, or if you've sold an asset and there's relevant tax to pay on that. Also, if you leave the country. Penalties and late payments. HMRC and Companies House take a direct responsibility very seriously. So if certain items are not filed on time, you personally can be liable for fines and fees. The company can be struck off from the registrar, and also you can be disqualified as a company director. So such filing as the confirmation statement, if this is not filed on time, your company can be struck off from the registrar. Also legally, the company should be keeping records up to 6 years after the year-end date. If this is not done, the company can be fined up to £3,000.
What is a director? Directors are responsible for overseeing a company and are responsible for all decisions in its day-to-day operations. A director looks after the company on behalf of its shareholders. There are no formal qualifications or special arrangements required to become a company director. Actually, there are only a few, albeit important, restrictions as to who can apply. A director must be 16 years old, have no history of bankruptcy, and can't be prohibited by a court order. Director's responsibilities. If you're unfamiliar with being a director, there are a number of responsibilities that you must maintain. On becoming a director, you're entrusted with the legal responsibility of presiding over a company. By forming a limited company, you are in effect establishing a separate legal entity to yourself. It has its own legal rights and accountability. Any losses or profits incurred belong to the company. You must make decisions for the benefit of the company and not yourself. This may seem confusing if you're a sole shareholder, employee, and a director, but a decision that may benefit you personally may adversely affect the company position. You must run the company in accordance with the law and rules laid out by the company's Articles of Association. These are guidelines to making decisions which you and any shareholders agreed to when you incorporate the company. An example of this is legislation affecting your employment status, which is known as IR35. We have a separate video available on this subject. Keep the company's registers, records, and report any changes to Companies House and HMRC, such as registered address, addresses of shareholders, company shareholders register, and persons of significant control register. You have a duty to keep an honest and transparent record of the company's accounts which reflect the finances accurately. However, HMRC may decide to investigate your company. Register with HMRC that a personal tax return should be submitted when you receive earnings where tax has not been deducted or paid by someone else on your behalf. You also have a responsibility for ensuring that the company is not taking illegal dividends. It is vital to keep a proper record of books and accounts to avoid any legal problems. Any illegal dividend is where you don't have enough profit to pay the dividend. The crunch system tells you if your account is up to date and reconciled.
So, what will you need to file personally? As a director, you need to file your personal tax return, also known as a self-assessment, no later than the 31st of January after that relevant tax year. So as an example, in the 16-17 financial period, which ends the 5th of April 2017, you need to make sure you file your personal tax return and pay it no later than the 31st of January 2018.
Understanding salary and dividends. As the director of your new company, it's really important you understand salary and dividends. As a director, you are therefore an employee of the company and therefore can take salary for the work you do. Dividends are when profits are distributed to all shareholders. The dividends are a reflection of how the company's performed, and therefore the dividend should be paid periodically based on company profits, rather than fixed at certain amounts throughout the year. With salary and dividends, it's very important they're paid at separate times, so please ensure they're not on the same bank transaction. What salary should I take? As a new director, you might be asking, what salary should I take? As a director, this is your choice and one you need to make. If you're outside of IR35, it's normally more tax efficient to distribute dividends rather than taking a large salary. However, it's worth noting it's still important you take a small salary. This is because if you don't take any salary at all, you don't make a qualifying year for state benefits. The table contains the current tax rates for 17-18. It is a qualifying year for certain state benefits when the salary is more than £115 a week or £5,876 a year. You start paying Class 1 national insurance when salary is over £155 a week or £8,164 a year. You also have a personal allowance. This means when your salary is above £11,500, you start paying income tax. However, if you have employees, you can claim the employment allowance. This means it might be worth taking a higher salary up to the personal threshold of £11,500. How much tax do I pay on dividends? I will now go through the following rates that you pay when issuing dividends to yourself. These are all based on when you have a salary of £8,000 and you have no other income outside of your company. This table illustrates this point. For the current tax year, you get a £5,000 dividend allowance, so this is taxed at 0%. To utilise your personal allowance, you get a further £3,500 at 0%. Once you've utilised your personal allowance and dividend threshold, as a basic rate taxpayer, you pay tax at 7.5%. As a higher rate taxpayer, you pay tax at 32.5%. When your total income, including both dividends and salary, is over £100,000, you start losing your personal allowance. Therefore, the effective rate of tax will increase to 42.2%. When your income is above £150,000, you then pay tax at 38.1%. As an additional taxpayer, or in this example, when your dividends are more than £142,000, you pay 38.1% of tax. Example of tax on dividends. The first £5,000 is at 0% because of the employment allowance. The next £3,500 is also at 0% to utilise your personal tax threshold. Between £8,500 and £37,000, you pay 7.5%. And between £37,000 and £70,000, you pay tax at 32.5%.
What is VAT? You may have come across this term, or this may be the first time you're hearing about VAT. VAT stands for Value Added Tax, and is probably one of the main taxes a business will need to pay in the UK. So here's some additional points regarding VAT. Now, VAT is only charged to your clients when the business is VAT registered. VAT is charged on certain goods and services, and the normal rate of UK VAT is 20%. But there are other rates, and we will address this later on. So the business must register for VAT when the taxable income is above £83,000 over a rolling 12-month period. Please note this £83,000 figure is only current for the 2016-2017 financial period. However, the business can voluntarily register for VAT even if its turnover is below this £83,000. The business can deregister once taxable income is below £81,000 over a 12-month period. VAT returns are filed and paid every quarter when registered for VAT. Those on the standard VAT scheme are also able to offset the input VAT they pay themselves on business-related purchases and expenses, although they must have a valid VAT invoice.
When can't you register for VAT? Well, you can't register for VAT when you're within a VAT-exempt industry. Here are a list of examples.
What is the flat rate scheme? Well, the VAT flat rate scheme, or sometimes written down as FRS, was set up to simplify VAT for small businesses. Now, the flat rate VAT scheme, you charge the usual 20% to your clients. However, the business pay back a reduced flat rate fee to HMRC. Now, for the flat rate scheme, I would recommend going to HMRC's website and seeing which band your business could potentially fall under. Here's an example of the flat rate scheme. I know when you first read about the flat rate scheme, it can be daunting with all the information available, but in this example, we'll run through using a business using the photography sector. In this example, we can see we're issuing an invoice to our client for £1,000, and we're charging the VAT as standard at 20%. So the total we're charging to our client is £1,200. Now, the flat rate VAT sector for photographers is 11%. So you'll be charging the 11% on the gross amount, the £1,200. Now, the VAT you receive from your client is £200, and if you subtract the £132 you owe to HMRC from our previous calculation, less the VAT we receive from our clients, would give you a VAT saving of £68. Do note that the first year being on the VAT flat rate scheme, the business does get a % discount. And also, in the previous example, we've not included any VAT being claimed back for expenses. When can you join the flat rate VAT scheme? For the business to be eligible to join the flat rate scheme, it must be a VAT registered business and have a turnover less than £150,000. When is the business not eligible to join the flat rate scheme? The business is not eligible to join the flat rate scheme if you've left the scheme in the last 12 months, you've committed a VAT offence in the last 12 months, your business is too closely associated with another business, or you've joined a margin or capital goods VAT scheme. Please do pay special attention to the previous point where your business is associated to another business. The reason for this is that HMRC have paid particular attention to this area recently. When do you have to leave the scheme, and what are the conditions for doing so? Once you've joined the scheme, you must leave the scheme and start paying VAT in the usual way if any of the previous conditions we mentioned beforehand start to apply. Or on the anniversary of joining, your turnover in the last 12 months was more than £230,000, including VAT. Or, on the anniversary of joining, you expect your turnover to be more than £230,000, including VAT, in the next 12 months. Or, you expect your total income in the next 30 days alone to be more than £230,000, including VAT. Should you register for VAT? If you're planning to invest heavily in your company, it may be a good idea to become VAT registered before the business hits this threshold, as it will allow the business to reclaim the VAT back on its purchases. I'll give you some examples and pointers which may help in your decision on becoming VAT registered.
You must register for VAT if your income is above the VAT registration limit over a 12-month rolling period. For the current tax year, 17-18, this is £85,000. However, if your income is under this threshold, you still might want to register for VAT. For example, If you're planning to invest heavily in your company, you could save money by registering before you hit the threshold. Doing so will allow you to reclaim VAT off business purchases. Another reason is if your customers are businesses where they can reclaim VAT.
If you do have any further queries about the flat rate VAT scheme, or also the standard VAT scheme, by all means, please do get in contact with us and we're more than happy to help you with your queries.